Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are talking about insurance and life insurance in particular, but I assure you I am excited.
Yes, well, that's good. So we are joined today by Phil Thompson. He is the founder of Skye Wealth, an advisor that specializes in life insurance. As we go through this episode, I hope we make it clear that life insurance is something that you should be considering as part of your, your holistic financial foundation. It's something that I really only turned my attention to over the last sort of 12 months or so. But it is certainly something that is very important to consider.
Yeah. I mean, we've both gone through the process with Skye and Phil's team, and it is something that you don't really learn about. I mean, financial literacy generally is something we don't learn about in schools, but that's a whole separate conversation. But I think for me, the thing that really opened my eye was we all have some form of life insurance through super, but the majority of us are woefully underinsured. But we can actually work with advisors to be properly insured and get our super funds to pay for it. So for me, that really opened the door to this whole world, and the process with Phil's team has been great. In today's episode, we're going to talk about some of the fundamentals of life insurance, what everyone should know, and then we're going to talk about how we can reduce the premiums. Like what can we do around structuring the product, around lifestyle, around timing of getting life insurance to reduce that sticker price of life insurance. And then we're going to close out with a conversation around expats in particular, because we know for Aussies living abroad, insurance is a real difficult area, and Phil and the team have been working with insurers to find a solution to that.
Yeah. Now, as you listen through this, if you're interested in exploring life insurances in a bit more detail, you can head to equitymates.com/advice, and there's a form there where you can directly request to be put in touch with Phil and the team, and they will take you through it. As Ren said, we've both gone through that process with Phil over the last 12 months or so. Without further ado, let's jump into it. Phil, welcome back to Equity Mates.
Thanks for having me, guys.
This is the first time you've joined us in 2025. You've
Yes.
been with us now for a couple of years. We want to start with a bit of life insurance fundamentals for a lot of the new Equity Mates audience that are listening to us for the very first time. So let's do a bit of a refresher. Can you walk us through what life insurance fundamentally is and the basic types of cover?
Yeah, cool. So life insurance is kind of an umbrella term, like health insurance, general insurance, and then life insurance is one of the three major types of insurance. And then the policies that you can have within the life insurance umbrella is life or death cover. So if you pass away, there's a lump sum that's paid out. Disability insurance, so total permanent disablement, lump sum payment if you can never work again. The next lump sum cover is trauma or critical illness. All insurers love to have different names. It just makes our job so much harder. But so that's a lump sum payment if you get diagnosed with a serious medical condition or that serious medical condition has a specific severity. So it's a lump sum payment. And then there's income protection. So income protection covers your income if you can't work because of illness, injury, sickness. So for any health reason you can't work, then they'll pay out a monthly benefit that covers a percentage of your income until you're back at work. And then if you're on and off work for a period of time or you're partially back at work, then there'll be partial payments, or you'll be on claim for a bit of time, you'll be off claim, and then you'll go back on claim.
Now, Bryce mentioned that you've been coming on the show for about a year now, and it's certainly been an education for me. So I think for people who are new to this whole world, I want to share some of my key learnings, and you can comment as I share them.
Let's go.
First one is most people in Australia have some of these insurances through their super. Second learning is most of those people are woefully underinsured. and I'll put my hand up. And I think
I remember our first conversation. You were saying, "Yeah, I got insurance. I'm sorted."
Yeah. And like my cover, I think is like 250,000 if I die or get permanently injured. And I worked with your team and you guys did some calculations and like woefully underinsured. But the third thing and the really interesting thing I think for people listening is you can up your insurance and you can move insurers, but you can get it paid through your super fund.
That's right. Yeah. So normally people think the only way I can get my super to pay for it is if I log into my account and then increase the cover through the super fund. But the way we've done it, the way we like to do it is set up the policy external to your super fund, but get the super fund to pay the premium. So that means if you move from, Oz Super to ART to Host Plus, wherever you go, you can maintain that insurance policy that you set up. And then it just gives you the freedom to move super policies if and when you want to.
Yeah. So if you're worried about cash flow and worried about paying for additional insurance out of your after-tax income, you can set it up to get the insurance cover that you need and pay through your super.
Yeah, exactly.
So, that was my big learning for 2024. Excited to see what I'm going to learn from you in 2025, Phil.
I love it.
So, Phil, I also went through the process with you guys last year, or actually probably, last year. And I think the two biggest catalysts for that were talking to you on the podcast.
Me yelling at you both, thinking you've got enough
there were
cover.
probably four catalysts. B, knowing that it wouldn't impact my cash flow as much as I thought it would, to Ren's point, could do it through super. But the other two were bought a house and got married.
Yeah.
From your point of view, are there key moments in life when we should be thinking about making sure we have the right life insurances, or is it just as early as possible?
So when it comes to life insurance, your health history has a big impact on the cover. So the sooner you get the cover in place, ideally the less health events that will impact your cover. But some of the major things that we think about is like if you've got a full-time job and you rely on your income for your future wealth, creation plans, or your family relies on your income, that's important to make sure you're starting to insure that. And then as the other life events are, you're buying your first house, so you got this massive mortgage. Yes, you may have a partner who you're buying it with, and they can probably contribute to the mortgage if you're out of work for a period of time. But for a long period of time, it's probably unlikely. Most Australians, we get up to debt in our eyeballs, especially for the first property, to get into the market. So that's another big trigger point. If you have kids or have a partner, they're really important. But I often like to think about kids more than getting married. If you're getting married, if you're financially reliant on each other and you're financially reliant on the income, yes, protect that. But once you have kids, it's such a bigger aspect to your life. We've got to then start to think about what happens if I pass away, what happens if my partner passes away. Regardless if one is not doing paid work, it's still really important to both get insurance.
The getting in when you're young and fresh, I think, was one that I became to understand as we went through the process. Like when you're healthy, when you don't have the opportunity, when you're not going to get exclusion after exclusion after exclusion, I think if you can get in there and get it while you're young and healthy, I think it's a big benefit.
And that's a big part of what we do in our job. Is like everyone's health history is like a big puzzle that we've got to solve. Is going like one insurer will exclude this aspect of their health and another insurer won't exclude that, but they'll exclude something else. So that's part of our job, is going, yes, premiums matter, yes, structure matters, yes, policies matters, but identifying that health history and how it's going to impact the cover is kind of the biggest part of the work we do.
So Phil, there's a couple of, topic areas we want to cover today, and the first one is around reducing life insurance costs, because you said premiums matter, and for a lot of people, they're sort of the sticker price that they're thinking about when they're getting insurance. So can you break down what factors insurers evaluate when setting premium levels, and then let's start talking about some of the levers we can pull?
Yeah, cool. So insurance, when it comes to like car insurance or home and contents, we've all gone through that. You've got to put your address in. When you're doing house insurance, you've got to put like, what is your roof? Like, is it tiled or is it colour-blind? All of these things.
Or like car insurance, it's like, where do you park your car?
Exactly. So that is underwriting. They're assessing the risk and the likely claim. When it comes to insurance, the risk assessment is, what is your job? And not just like what's your title, but what's your activities. So I've had a client who was a managing director of the company, but he drove a forklift all day, every day. And so, his title was managing director, but his occupation, his duties, his activities was forklift driver. So we needed to make sure we assess that risk. risk. So your job, are you male or female? They have a different premium structure. So males generally are charged higher premiums, or everything else being equal is life and TBD is more expensive for males, and income protection and trauma is more expensive for females. And that's just statistics, basically, the claim statistics. All insurers have that structure. Things like, are you a smoker? Pastime activities may have an impact on it. So, are you a mountain biker? They may want to exclude that on it. So they may not charge you more. Things like, are you a AFL footy player or a rugby player? So the insurers may want to either charge you a high premium or increase your waiting period for income protection. So there are some factors that the insurer will allow people to adjust for that. Even things like family health history has an impact. Like some people are getting higher premiums, so a loading on their premiums, because their family have had cancer at a specific age. Those things matter as well. So it's not even just you as an individual, it's also your family history that has a big impact. So there's lots of things that has an impact on the cost of cover. Health history is kind of the major one, as I said, is kind of the thing that we think about the most.
So all of those things are just like they're just going to be assessed on who you are. Yeah. So I guess then when people are thinking about it, like are there any effective ways of trying to reduce,
completely change who you are?
Just become get a job. That's easy.
Get a better job.
You should quit smoking.
Not true. I mean, anyway.
We've done your insurance application. So,
I mean, are there things that you can do leading up to it or during the process that you can sort of impact?
I mean, I definitely talk to an advisor. Like, an advisor who specializes in this stuff knows what is and isn't going to impact the cover. There are some things like once you get an understanding of the cost, we can adjust the premiums. Like the thing I love about insurance is it's not, this is the premium, take it or leave it. It's a matter of going, like, as advisors, we work with our clients to go, hey, let's come alongside you and go, what are you comfortable paying? This is the premium with the level of cover that is, that we think is important. But what do you want to pay? Because we can dial things down. So some simple things when it comes to things like income protection, the waiting period. So it's like a car excess. The higher the excess, the lower the premiums. So that waiting period will have an impact on premiums. So if you do a 30-day waiting period, that's more expensive than a 90-day waiting period. Now, the flip side is you've got to pay that excess at claim time. So everyone loves the higher car insurance excess until you crash your car and you're like, damn it, I've got to actually pay that. So thinking about that 30 to 90 day waiting period excess, that's something that we do quite a bit, but we also try and help our clients think about, like, if your monthly benefit is, let's say, $5,000 or $10,000, times that by 2, that's the amount of excess that is going to cost you if you're ill or sick or unable to work. And so you're going to be off work for 90 days before you'll start getting paid versus 30 days. So if it's that, $10,000 per month benefit, times 2, because we're going from 30 days to 90 days, that's $20,000. If that's going to save you $1,000, is that worth it for you or not? And they're the discussions that we talk to our clients about. And then, the lump sum covers, there are benefits, features with the policies that any good advisor will chat about. Hey, if you want to bring down the costs, we can dial down the level of cover. Some things that you don't want to really consider is like life insurance is the cheapest part of it. And often it's linked to disability. For our younger clients, we often have the same amount of life insurance as their disability because it actually saves money. So even if they don't actually have the need for life insurance, we'll add it in because it's going to be cheaper overall. So things like those lump sum covers, even though they're the biggest numbers that we're insuring for, bringing that down will have a really minor impact on the actual cost of the cover.
Yeah, so I went through equitymates.com/advice and spoke to Trent in your team. And
you didn't have a direct line in?
Well, I wanted to make sure Equitymates got credit for the referral.
True.
Yeah. I like it. I'm sure you would have. I'm certain you would have.
And Trent originally was like, look, if we want the whole hog, this is kind of like the maximum level of insurance and this is what you would pay. And then we had a conversation around like, reducing premiums and structuring it in a way that you just explained there, which I found helpful because it wasn't just a binary, like, here's your offer, take it or leave it. Yeah. So some of the things you explained there were around policy structure. I guess the other part of this question around reducing costs is the lifestyle stuff. And, the obvious one is if you're a smoker, stop smoking.
Yeah.
But what are some of the other like high ticket, high impact lifestyle changes people can make?
Yeah, so I mean, drug use is an easy one.
Okay.
So insurers decline for recreational drug use. So like things like marijuana is generally not that bad from an insurer's point of view. Some insurers will say, no, we won't touch it. But recreational drug use is basically you're in and you're out when it comes to insurance. So that's something that, from a personal level, don't take recreational drugs before an insurance application, and they'll want to have a period of time. But smoking is one really simple one because they charge you like 50% extra, sometimes even more on your covers.
For our modern electronic smokers, is vaping seen the same way?
Yeah, seen the same way.
And what's the window though? Because in the application, it's like, are you or were you a smoker?
Yeah,
if you were,
12 months.
Okay.
So if you're not smoking for 12 months, then you're fine. So that's why.
So they don't consider if you'd been smoking for 40 years.
Yeah.
And you've quit
no
12
issues.
months ago.
Yeah, it's
no
crazy.
issues.
It's crazy. Yeah.
They don't do like a percentage chance of relapse.
Yeah, they don't check your lungs and see how much tar you've got in there.
Wow.
Yeah, it's just a 12-month window. So that's why some people, would have smoked, 8 months ago, and we'll tell them, hey, this is the recommendation. There's a loading. As soon as you're 12 months, smoke free, we'll contact the insurer and we'll just remove that loading. And so.
Oh, okay. So you can do it that way.
You can take out the cover with the loading on. Even if you plan to, some people plan to quit smoking, it takes them a while. It takes 7 times to quit smoking or something.
Can you do that with exemptions as well? Like if you, for example, me, because I've got stigmatism, if for some reason down the track, my eyes have improved, I can call them up and be like, I actually don't need glasses anymore.
Yeah. So with all exclusions, there is an opportunity to review it. Now, as a part of our process, we'll normally ask the underwriter, is this reviewable at some time in the future? Some underwriters will let us know based on what we know, it's unlikely to be reviewable because of whatever reason. So like a good example is scoliosis. We'll often have a back exclusion for scoliosis. Now, that's not going to magically improve. You're going to have scoliosis for a long time. And so that back exclusion will unlikely to be removed in the future. But things like, smoking, mental health, if you, no longer have treatment symptoms, even though you've got a diagnosis, then we can get the mental health exclusion removed in the future. So a part of our process is at the end of the process, once we know the application is there and they've got all the information, we'll let the clients know, hey, this is reviewable or it isn't reviewable based on what the insurers told us.
So in terms of reducing costs, we've covered the structure of the policy and then some lifestyle factors. I guess the last one that we're interested in asking around is around timing. So is there, how does timing generally affect life insurance costs and premiums? And is there an optimal age to purchase a policy to balance, I guess, minimizing the premiums versus making sure you've got the coverage you need?
Yeah, so it's a good question. It's something we're working through internally at Skye. So there are 2 premium structures. So they've changed the names. APRA, the regulator in its infinite wisdom, came up with these stupid names for these things. But effectively, the old names are stepped and level premium. So level was higher premiums today, but it won't increase based on you getting older. So now the premiums can change. If your level of cover goes up, then the premiums go up.
But if your level of cover doesn't change, it's basically like a fixed price contract.
Except the insurers can change the price. So they can change the price across all of it.
Right.
Yeah.
Okay.
So there is a mechanism for insurers to go. It's kind of like, California fires where, the government capped the increases they could make on there. And so a lot of the insurers in California pulled out of the market because we don't have a mechanism to reprice these policies to price them accordingly. So that's why the government still allows insurers to reprice level premiums. So level premiums was you lock in the age at which you take out the cover. Every year you get older, assuming your cover doesn't go up and assuming the insurer don't increase the price, your premiums don't go up. Step premiums, which is the lower today but increases as you get older, has 3 reasons why it can go up. So the insurers can reprice, just like they can every policy. If your level of cover goes up, then the premiums will go up. But there's always an age-based increase. Every year you get older, there's a higher risk of a claim, therefore the premiums go up. So they're two structures that we've historically liked level premiums in our business. We are moving away from it a little bit, not necessarily because of repricing, because they've been doing that a little bit. And that's been a known in our business. But there are some things in insurance land where insurers are discounting stepped premiums for new customers and building in like this loyalty tax, which I could geek out for a long time and about my frustration to it, because effectively you want to sign up with the policy for a long time. So we're moving towards recommending more of those stepped premiums. So, but theoretically, I've got a level premium and I'll keep my level premium policy. But that is a way, if you get it in as early as possible, it still may be a really good idea to set up that way.
Do you always get the choice? Like between level and step?
Yeah, I mean, like if you're over 55, I don't think you get a choice.
Yeah,
it's always step. We always get the choice. And as an advisor, so if you go through your super fund, you don't get those options. It's just advised policies. As an advisor, we make a recommendation and then we give our clients the option of going, hey, if that's, if we've chosen that level policy, then we can move to step and save your premiums. Or if we've chosen the step premiums, then we can make it more expensive, theoretically cheaper over time.
So Phil, we're going to take a quick break here, and then on the other side, we're going to close out the conversation around reducing costs. We're going to also talk a bit more specifically around mental health and insurance, and close with a conversation around insurance for expats. Welcome back to Equity Mates. We are talking with Phil Thompson of Skye Wealth, our insurance expert here at Equity Mates. So Phil, we're chatting around reducing costs. I guess one last question we have in that space is just, are there any specific types of insurance or particular add-ons around insurance that people commonly think they need or people commonly purchase that you think might not be worth the squeeze?
Yeah, so hey, this is going to be incredibly conflicted advice. So bear with me. Go to a financial advisor to review your cover. If you've gone to the super fund and increased it, it's often more expensive. We did a massive research internally, quoted 500 of our clients, like as fresh, brand new clients, looked at their super fund that they were with versus the insurer we recommended, and it was 34% more expensive to go through the super fund. So there's this big misconception going through the super fund that, Australian super insure, millions of Aussies. It's going to be the cheapest price policy. And it's just not based on our analysis. So that's massively conflicted advice. So if you're having,
why is that conflicted?
Yeah.
Because I'm a financial advisor and we make
money. You're talking your own book.
Yeah, that's right. Yeah. So, but
isn't everything this episode then conflicted?
Yeah, correct. But people, we've been told a lot. Go to your super fund; it's cheaper. There's group buying. It's cheaper through your super fund. But this day and age, it just isn't.
I was under the impression that the base level of cover is generally cheaper because that's grouped by like massive insurance pool of super clients. But then as soon as you start trying to increase or make it bespoke, then the cost blows out because the insurance company kind of knows they got to capture.
Yeah, sometimes they do that. There are some companies that do that. There is a trend away from it. So the base price has actually gone up.
Oh, really? Okay,
But theoretically, the whole pricing is built in the same. But that used to be the case. Like 2 years ago, we would always see the base cost is like cheap as chips. And when you increase it, the cost per $1,000 worth of cover was heaps more than the initial cost per $1,000 worth of cover. But now they've leveled it out, which by leveling it out means everyone's base premiums have just gone up for that default level of cover. But the reason why it is cheaper is because as an individual, you guys have gone through it. You go through underwriting. So the insurer knows all about your medical history and they can put exclusions and loadings on it. With group policies, they've got a huge member base that haven't gone through underwriting. So you may have a health issue and get that policy and then claim on it. So their claims experience is much worse than an underwritten policy.
Yeah.
So that's why it is cheaper to go through underwriting.
So the takeaway for this episode for people is on average, the going through an advisor insurance is 34% cheaper than going through your super fund.
Yeah, based on like 500 of our clients.
Yeah.
And we skew young, like our average client age was like 35 or something. So
Nice.
definitely potentially on average, maybe. All the disclaimers. Yeah.
Based on the available evidence. Yeah. Contact Phil for the full data methodology.
We've got a massive report we're about to. It's on my desk and it's just been put down there. It's been put down the bottom of the inbox.
Yeah, right. Okay.
But we're fully geeked out on the numbers.
Nice. Now, Phil, we want to turn to mental health assessment because that has a big implication on premiums. How's industry's approach to mental health changed, I guess, over the last few years when it comes to determining premiums and eligibility?
Yeah, so when it comes to mental health, the insurers, there was an insurer who put a loading on for mental health history instead of an exclusion, but they've gone away from that. Everyone's just doing an exclusion or offering cover. But we can talk about mental health when it comes to claims experience, and claims is a massive impact. Mental health has been a huge impact on claims for insurers. Like something like, 25% of all disability, which is that you can never return to work again, 25% of those claims are mental health across the board. Something like there's been like a 400% increase on mental health claims for younger people. So I think the insurance industry body, Carly, did a report, and I think it was like 400% increase for 30 to 40-year-olds on mental health claims. So mental health on a claims point of view is a huge drag on the industry, and it's costing us all when it comes to insurance policies. So, we as advisors, we hear about, it's a very backwards way of thinking about mental health in terms of the assessment when I'm taking out cover. And we empathize with everyone. And at the end of the day, I don't want a mental health exclusion on my policy, and I don't want it on any one of our clients. However, knowing that it costs us all, when we talk about repricing of policies, the biggest driver of repricing of insurance policies in the last 5 years has been mental health, and it's a steep increase. So there are some things that the insurers are doing is they're changing their policies. So disability insurance, what is trending, and I've had conversations with one of the biggest insurers in the market. They're going to offer a disability policy that for everything else will pay out the same amount. If you claim on it and you're accepted as claim, we'll pay you the full amount. But for mental health, we'll make an assessment over 5 years. So we'll pay you 1/5 of the disability claim every 5 years. Now, the way they're going about it is thinking about we'll make the mental health assessment once, but as long as you don't go back to work within that 5 years. So if you return back to work, then they won't pay you that extra 1/5. Now, that's not in the market at the moment, but that's just some of the conversations insurers are talking about. How do they manage that? On Thursday, I'm in another insurer advisor board meeting, and they're going to be talking. The whole conversation's around mental health claims.
So for individuals, so that's like at a corporate level and a society level. For individuals who are just trying to get insurance and try and cover themselves for eventualities, like how should we navigate the potential for mental health risk, and what advice do you have for individuals?
Yeah, so just broadly, I'll talk about how insurers assess it. So if within the last 3 years, if you have any symptoms or treatment or time off work, you're likely going to have a mental health exclusion on the policy, and that's for two of the policies that I talked about. So for income protection and disability cover. So those two policies will have a mental health exclusion. If you have a diagnosis and you've been on treatment for a long time and it's really successful, then we can maybe get cover without it because you've got a long history. So one thing that the insurers only have one assessment today, and they've got to cover you for the rest of your working life under this policy, because if you set up an individual policy, the insurer can't cancel it. There's no mechanism for it to be cancelled unless the insurance company falls over, which hasn't happened to date. And so it means that they're going to be so much more strict up front. If people think, well, I haven't had any symptoms or treatment for 12 months, that may be reasonable, and that is a reasonable way of thinking that they shouldn't penalise you for it. But the insurer can only look at it once, and then they've got to cover you for it. So if they don't put the exclusion then they can never change their assessment in the future.
So Phil, you have, I guess, first-hand experience or exposure to a lot of these big discussions around the future of mental health assessment. What can we expect to see down the track?
Yeah, I mean, I don't expect it to be getting any better. Like there are workers' compensation schemes, so workers' compensation, work safe, work cover,
Work cover, yeah.
And in Victoria, work cover has changed the rules where they won't cover mental health for normal stresses or normal overworking. That's pretty significant because that's like a government-backed scheme to protect the workers. And if they're not going to be covering mental health or significantly limit mental health claims, it means it's going to be pushed even more onto your own personal cover. So whether you've had, experience with mental health condition in the past, it's super important to get policies as soon as possible. Again, talking to my own book, but I can see it only getting worse. It's not getting better.
Yeah.
Yeah. So my takeaway from this is that government-backed policies are going to limit mental health coverage because there's so many claims happening. And as soon as you have symptoms of mental health issues, then private insurers will put an exclusion on your policy. So really the only way, if you're worried about this stuff, is to get it early. Yeah. And the fact of the matter is a lot of us don't know.
Yeah.
I don't know in 5 years' time I'm going to suffer a mental health condition.
So to get back to it, the only solution is to speak to Phil.
Point to Skye. Exactly, guys. I appreciate it.
But it is worth thinking about. And I imagine, do they ask about family history of mental health?
No. Family history doesn't come into it. But again, it's just one of these things. It's just super important. Like it's like getting debt. I don't know if you guys have ever wanted debt when you can't get it. You can't get any credit. It's like
a mortgage.
So a mortgage or a credit card or any kind of debt.
We're
it's
young Australians, of course we are.
You want to get it when you don't actually need it, because when you need it, you're not going to get it. And it's the same when it comes to insurance. You want to make sure you set it up properly. And the good thing, work cover can change their terms and conditions anytime they want, and they have in Victoria. But your personal cover, once you sign up for the policy, what you have can never be changed on you.
So this is probably the time to say, if you want to speak to Phil and the team, equitymates.com/advice. Bryce and I have gone through the process. A number of Equity Mates have. So go and speak to Phil and the team. Not just if you're in Australia, because do you like that segue? Pretty good segue.
Not bad.
Because Phil and the team have been working hard on a solution for expats. So tell us tell us the situation pre-Skye and post-Skye as well.
So since COVID, all insurers in Australia have said, no, we're not going to touch anyone living abroad. And there's like 400,000 people living in like the Middle East, like Aussies living in the Middle East working, because there's heaps of Saudi money, there's heaps of money in Dubai. So there's a lot of like white collar workers going there to make as much money as we can. And so Aussie insurers have said, we're not covering anyone post-COVID.
Not just in Saudi Arabia, any expats.
Yeah, correct. There is
in Saudi Arabia. Solution, don't go to Saudi Arabia.
I thought you were going to say there's 400,000 Australians in like one suburb in London.
No. In the Middle East, I believe there's like 400,000 Aussies.
Okay.
And during that time, post-COVID, there was legislation where all default cover for those people were probably cancelled. Under the Protecting Your Super legislation. So it meant that these people who are living abroad couldn't get new cover set up, and their policies within their super fund likely had gotten cancelled. So we've got some really close referral partners that work closely with Aussie expats, and they said, hey, can we get any insurance cover? And we spent 18 months working with insurance companies saying, hey, can we do something about this? And there was one company who came on board and said, yeah, we'll do a trial run with you guys. And so that's really what I'm here to basically shout, from the rooftop is, if you're an expat, you haven't been up, you may never have thought about insurance cover, but now you've never been able to get it in the past, and now you can get it.
Why do they not want to cover if you're living overseas?
I mean, there's jurisdiction issues. Like, are we selling into this jurisdiction? Like a lot of the Aussie insurers have like global companies, like Zurich's one. Their headquarters. Have a guess where that is.
Zurich.
Switzerland.
Bam. Exactly. So they have, Zurich can cover people in different jurisdictions. It's more a politics thing. They don't want to be seen to be selling into that jurisdiction when their other company can be selling into them.
I mean, I'm sure there's also quite strict insurance regulations.
It's like, you guys are well aware of how strict Australian financial services laws are and how you can't sit on a podcast and talk about stuff without being licensed.
Yeah.
It's similar to that. There are some jurisdiction issues. And so they have said, yes, there is risk because, people are living abroad. What's their health going to be like? What's their health assessment at claim? There are some of those problems, but there are just jurisdictional issues.
Why does an expat need Australian insurance? Like if I'm an Aussie living in London, why should I get an Australian insurer to insure me rather than a UK
one
insurer?
in the UK, yeah. So again, one of these things about these policies in Australia is they're set today and they can never change in the future. And that's one of the great things about Australian, insurance companies. And so there isn't this moving target at claim time. It's going to be something different to what I signed up for. So that's one of the beautiful things about an Australian life insurance policy. Most Aussies who are living abroad, if something happens and they are injured, ill, sick for a long time, they're going to come back to Australia. This is their home, unless they've built, if they've, set up, shop in the UK, and they're probably never going to come back to Australia, then don't set up a policy in Australia. But a lot of the ones in like the Middle East, they're there to make as much money as possible for themselves and for their family. But their home is always going to be back in Australia. So that's why there is a level of mistrust with the policies over there as well. We don't know exactly what we're signing up for. There are multiple benefits.
And so if I'm an Aussie working in Dubai and I have an Australian insurance policy, if I get injured at work in Dubai, can I claim on the Australian insurance policy? Yeah, okay.
Exactly.
That's pretty good.
Now, if there are arrangements where they're getting paid sick leave or any kind of workplace arrangement where they are getting paid, then you're not going to double dip. But yeah, you can be injured from work or out of work. You go, I don't know, sandboarding. That's the thing in Dubai. You go sandboarding and you hurt yourself, you can still claim on your Aussie insurance policy.
So basically, like what the structure that you guys have set up allows not just expats, but like for people who may want to move overseas at some point in the future, like to just set up their insurance once and then be able to live their life, work where they want to work, come back when they want to come back, but have that insurance set up.
Exactly.
Protecting them wherever they are in the world.
If you haven't gone overseas, easy. We've got all the companies in Australia we can set up a policy for. So it's only if you're living abroad, you currently can't set up any policies. And that's what we've been able to do. There's one company who gives us really good options. Now there are like 10 countries that we can insure within, but that makes up majority of our clients. But there are some other insurers who will say if you return back to Australia within a really short time frame, we'll offer cover for them. But that's much more restrictive. And most people have rolling contracts. They're not exactly sure when they're returning back to Australia.
Love it.
Right. Well, if you're an expat living overseas, equitymates.com/advice. We'll put you in touch with Phil and you can get yourself sorted so you can go sandboarding in Dubai.
Yeah, let's go. And then invite me over.
Yes.
Well, Phil, thank you so much as always for coming up and talking us through some of the fundamentals and I guess some of the more specifics around life insurance. A lot to get your head around, but I do recommend that anyone who is listening and thinks that it's the time to start exploring this, definitely get in touch with Phil and the team because you certainly helped both of us. So we really appreciate it. Thank you so much.
Awesome. Thanks, guys. Thanks for having me.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.